The housing market in America is seemingly always at the top of the news cycle. Lately, low home availability and skyrocketing mortgage rates have dominated the headlines, with more and more Americans feeling unable to either afford or find a home they feel comfortable in. However, 20 years ago, the story around the housing market in the United States was in a much different place. Interest rates in the early 2000s were at all-time lows, and mortgages were being handed out seemingly like candy. While on paper it was a glorious time in the nation, a few French economists and financial experts saw through the market for what it was, a massive bubble on the verge of collapse. Enter John Paulson. The New York hedge fund manager had built his company on the premise of taking advantage of event-driven investments. And in 2007, that premise paid off in a massive way. By being able to predict the incoming implosion and betting against the US housing market, Paulson was able to generate a rough total of $15 billion, with $4 billion taken home in personal revenue, while countless other firms found themselves bankrupt in the wake of the greatest economic downturn since the Great Depression. What if I told you this unassuming Wall Street outsider made a bet against the titans of the finance industry and came out looking like a modern-day Nostradamus? Welcome to the story of John Paulson and the single greatest trade in financial history. It's safe to say that John Paulson wasn't always destined for ultimate financial success. He was born in Queens, New York in the winter of 1955 to Alfred and Jacqueline Paulson, of Ecuadorian and Lithuanian lineage respectively. His father worked in the finance industry as an accountant, but that didn't exactly give John the initial desire to follow in his father's footsteps. Originally out of high school, Paulson decided to embark on a career in sales. However, in 1976, after quickly realizing that he'd be unlikely to be able to provide a steady income long-term, he enrolled at NYU, where he found a love and passion for both business studies and finance. In 1979, he graduated summa cum laude in finance and went on to enroll at Harvard Business School, where he'd earned an MBA in 1980, again graduating with honors. Paulson entered the workforce a renewed man, ready to take on Wall Street and shoot his way to the top. Unfortunately, as is typical with Wall Street, that wasn't quite how it turned out, at least initially. Paulson began his career as a consultant at Boston Consulting Group in 1980, focusing on financial research. However, this didn't quite scratch the itch he had for corporate finance, and soon after, he took a job at Odyssey Partners under the famous Leon Levy as an associate. From there, he jumped to Bear Stearns as the managing director of mergers and acquisitions, and then to Gruss Partners as a general partner. By 1994, just 14 years into his career, Paulson had made great strides at each turn, but he wanted more. And so, he left Gruss to find his very own hedge fund, Paulson & Co. To Paulson's surprise and horror, he generated little to no interest in third-party funding. It seemed that seemingly no one was willing to hop on board with Wall Street's newest up-and-comer. So, with startup funds of just $2 million of his own money and just one employee, who ended up becoming his wife, Paulson set up shop in a rented space in the Bear Stearns building on Park Avenue with little more than a dream. The early days of Paulson & Co. were bleak, and it took the firm over a year to sign its first client. Paulson was generating some steam a few years later, but he still had a ways to go before he could be considered a driving force on Wall Street. By 1996, for example, his firm was managing roughly $16 million compared to larger firms easily averaging well above $100 million. However, the turn of the century would set the groundwork for Paulson's luck to change in a big way. In the wake of the September 11th terrorist attacks on the United States, the federal government aggressively cut interest rates in an attempt to boost customer confidence and renew a sense of life into the strangled U.S. economy. Because of this, Americans began signing mortgages at an unprecedented rate, looking to take advantage of such excellent terms. The big banks began drastically loosening their standards on mortgage approvals, essentially giving out home loans to just about anyone who asked, regardless of income or credit score. In fact, just 4 years later, by the year 2005, nearly 1 in 4 mortgages were requiring no down payment at all. Now, while on paper this may sound like the ultimate definition of the American dream, it would soon become a nightmare. The banks began shelling out thousands of these subprime mortgages all across the country before packaging them together and flipped them to investment banks, who in turn sold them to investors across the world as mortgage-backed securities. The issue, of course, with so many Americans gaining access to mortgages they had no business having is that soon after, they began to default, unable to pay what they owed. This started a chain reaction that set the global economy into a tailspin. Most experts on Wall Street did not see this as a possibility. However, a man by the name of Paolo Pellegrini did. Pellegrini, in a last-ditch effort to revive his career, had approached Paulson for a job. Once on board at Paulson & Co., Pellegrini noticed something that everyone else seemed to be missing. If housing prices continued to go up, mortgage defaults wouldn't be an issue, as banks could repo the homes and still have profits to sit on. However, Pellegrini's research unveiled that after a 20-year steady increase of home prices at just over 1.4% per year, they had skyrocketed roughly 7% each year from 2000 to 2005. There was absolutely no way this trend could continue without a massive correction. Thus, Paulson came to the conclusion that once housing prices fell, the entire world of mortgage-backed securities would cripple almost simultaneously. Thus, the two came up with a plan. Paulson & Co. would purchase a massive amount of credit default swaps, which are essentially insurance policies on mortgage-backed securities. The trade had a massively skewed upside. Because these swaps only cost 1% on average, the firm risked losing a little to gain a whole lot. After doing a ton of due diligence, the firm decided to target tranches or groups of mortgage-backed securities that were rated a BBB, which were the least safe groups still rated as safe for investment. Over the following months, Paulson bought $25 billion worth of these swaps from all of the major Wall Street banks and began a new fund to bring in outside investors who wanted to join in with him. He found this difficult. However, as he was viewed as an outsider on Wall Street, someone with no housing expertise. While there were a few on Wall Street who believed in the idea, they ended up selling early or not risking more than a modest amount. No one else seemed to have the fortitude to believe in Paulson's strategy, and because of that, their earnings were severely capped. When Paulson approached his contemporaries with the idea to buy into the credit default swaps and was essentially laughed at, that was nothing new. The truth is, the other big banks had a point. He was an outsider who had seemingly no true knowledge or experience in the housing market. He hadn't been able to prove that he could be a reliable forecast for economic events. He had yet to make a true impact on Wall Street, regardless of the time and effort he put in. On top of his perceived lack of knowledge and understanding, Paulson's age also played a factor. By 2005, as he was looking everywhere to find outside support for his backing of credit default swaps, he was already 50 years of age, without a single big break to point toward. He'd spent much of his adult life clawing his way to the main stage, but it seemed he had a stage fright of sorts. He just couldn't seem to close the big one that all major Wall Street players do in their careers. The large bond credit rating firms like Moody's and Standard & Poor's believed wholeheartedly that the system wasn't set up to fail, and so did the large majority of Wall Street executives, and by proxy, their investors. John Paulson was the true outsider, leading a charge from the back corner of Wall Street that had the opportunity to change everything. In essence, Paulson had decided to bet big against the US federal government, but he didn't stop there. Once he realized that Wall Street collectively had spat in his face at the idea of the impending failure of subprime mortgages, Paulson began buying swaps against some of the largest Wall Street banks who supported them. He had ensured that if the housing market that the experts all swore was bulletproof did go south, he would emerge from the smoke as the smartest guy in the room, or in this case, the smartest guy on Wall Street. While the majority of his contemporaries shrugged off his cries to buy into these credit default swaps, his new fund focused on acquiring them was able to generate some modest traction from outside investors of roughly $150 million, a majority of which came from Paulson's personal friends. Paulson ensured that his firm's number one priority was acquiring as many credit default swaps on mortgage-backed securities and on the firms that stood by their resiliency. While the rest of the financial world balked at his ludicrous obsession, Paulson sat back and waited with bated breath as 2005 turned to 2006, awaiting any sign of movement on the collapse of the housing market. Halfway through 2006, the housing market had begun to slow down considerably, but the mass influx of mortgage defaults had not yet come. Paulson's team began to admit nervousness, as many of their credit default swaps were only active for 2 years. If their predicted collapse did not come in time, they'd be left with no gain to speak of, and would become even more so the laughingstock of the financial world. While many of his inner circle began to spiral into uncertainty, including his wife, Paulson remained steadfast, declaring that it was simply a waiting game. He'd seen the models 1,000 times, and he wasn't about to give up on what he believed to his core was an impending implosion. A few months later, Paulson finally got a sign of what was to come. In August of 2006, the nation's second largest lender of subprime mortgages, New Century, reported a highly unexpected loss and saw their stock price plummet by 17%. The loss, brought on by a ballooning number of lenders being unable to pay their mortgages, was the first spark in the financial wildfire that was to come. A year later, the brush fire would become uncontainable. In 2007, 2 large Bear Stearns managed funds heavily invested in mortgage-backed securities were decimated, triggering a near-instant market-wide meltdown. By 2008, long-standing firms such as Bear Stearns, Fannie Mae, Freddie Mac, and Merrill Lynch had all been acquired by either another firm or were taken over by the federal government. In September of 2008, the collapse came to head when Lehman Brothers, which had been founded back in 1850, went bankrupt and had to close its doors after failing to be acquired. The failure of Lehman Brothers still stands as the largest bankruptcy in American history, and the markets were sent into further turmoil. Foreclosure rates hit a staggering all-time high. Unemployment skyrocketed. Millions of Americans saw their lifetime 401k savings dissipate seemingly in an instant. It was a dark, dark time in the economic life of the United States for just about everyone. Everyone except John Paulson, that is. By having ultimate faith in the eventual failure of the US housing bubble, Paulson & Co. generated $15 billion in 2007, $4 billion of which went to Paulson directly. $5 billion more was earned by the firm from 2008 to 2009, $2 billion of which went to Paulson. All in all, Paulson generated personal income of just over $6 billion in the immediate aftermath of the subprime mortgage collapse. After being chided, dismissed, even laughed at, John Paulson came through one of the darkest economic events in the world's history with a fortune. Against all odds, the virtually unknown hedge fund manager had pulled off the single greatest trade in financial history. Paulson became somewhat of a financial celebrity almost instantly. In 2009, on the back of his monstrous trade, Paulson was the head subject of the New York Times best-selling book, The Greatest Trade Ever Made by Gregory Zuckerman. Paulson's personal take-home in 2010 was nearly $5 billion, setting a new single-year Wall Street record. Interest in Paulson & Co. funds skyrocketed. All seemed to be going according to plan. However, in the years since he pulled off the greatest trade in history, not all has gone as well for John Paulson. Over the years, Paulson & Co. funds have seen years of great loss, and many within the finance industry have begun to shy away from Paulson as a solvent figure. In 2021, he filed for divorce from his longtime wife Jenny, and the proceedings have been interesting to say the least. In 2023, it was reported that Jenny was accusing Paulson of using a fraudulent purchase of Puerto Rican real estate to inflate his worth by roughly $10 million at the expense of his family trust. She also claimed that by setting up a number of irrevocable trusts, he was able to shield his wealth from her in the couple's divorce proceedings. Paulson also came under hot water in early 2024, when in a similar case involving a Puerto Rican car dealership he had purchased was ruled in court to be fraudulent. To this day, the couple's divorce still has not been finalized, and Paulson is still facing millions of dollars of fines in multiple fraud cases. He is also being actively sued by both his ex-wife and a former business partner, Fahad Ghaffar, both on fraud charges. In terms of Paulson's investments post-housing crisis, it's been a bit of a mixed bag. By the early 2010s, Paulson had bolstered many of his funds by investing heavily in gold. The idea was that this would be somewhat of an insurance policy to stifle the volatility of his investments, as he'd seen his largest funds suffer heavily in 2010 and 2011. However, due to a sharp decline in the value of gold, Paulson's funds took a huge hit in the fourth quarter of 2011, and the billionaire saw his net worth decline from an estimated $14.4 billion in 2011 to just $4.2 billion by 2020. In the summer of 2020, Paulson had had enough of the bleeding, and it was announced that Paulson & Co. would be returning their shrinking number of investors all their money back and transitioning from a hedge fund into a private investment fund for his own family's wealth. It hasn't been all bad for the billionaire, though. After being brought in as a close financial investor to President Donald Trump in 2016, his name was recently floated again during Trump's 2024 campaign to retake the White House, this time as a potential Treasury Secretary. While campaign officials have not officially confirmed the discussions surrounding bringing Paulson on in a cabinet position, multiple news outlets have reported that preliminary talks have taken place, and that there is a mutual interest. On top of his budding political career, Paulson has also made winning trades in recent years. He was a large investor in the drug company Horizon Therapeutics, who were recently acquired by Amgen for just under $30 billion. He also holds shares in Piraeus Financial Holdings, a Grecian bank, and the manufacturer of Steinway pianos, both of which look ripe for solid returns. Despite the legal turmoil that has surrounded him without cease over the past few years, and a more than $10 billion decrease in his net worth, there is no denying that Paulson will undoubtedly go down as one of the greatest Wall Street figures of all time. When an entire industry failed to see a massive problem, Paulson was able to pinpoint it and profit immensely from his due diligence. The greatest trade in financial history wasn't by luck or happenstance, and it didn't come as a product of established Wall Street killers at the top firms. Instead, it came from an industry outsider from Queens whose belief in himself led to a life-changing outcome. Thanks for watching, and be sure to let me know your thoughts in the comments below. Until next time.